In global trade, there is a simple reason letters of credit still matter. Exporters do not always know the buyer well enough to ship comfortably on open account, and buyers do not always want to release funds before shipment without some structure protecting their side. The bank steps into that trust gap as a documentary intermediary. In this episode, we break down why letters of credit still sit at the center of global trade, how the payment mechanism actually works, where exporters get tripped up, and why a commercially sound shipment can still become a payment problem if the document package does not match the credit exactly. Why do letters of credit continue to show up in cross-border transactions when the market has so many other payment tools? Because they solve a specific problem. The exporter wants more confidence than open account can provide. The buyer wants more control than prepayment gives them. A documentary letter of credit creates a bank undertaking tied to defined terms and documents. That can materially improve payment discipline, but it does not eliminate risk. It changes the question from whether the buyer feels like paying to whether the exporter can produce a complying presentation under the credit's rules. That distinction is what makes the instrument powerful and what makes it dangerous when people oversimplify it. At a practical level, the structure follows a clear sequence. The buyer asks its bank to issue the credit. The exporter reviews that credit before shipment and confirms that the wording is actually workable. The goods are then shipped, and the exporter assembles the required documents. Those documents are presented through the relevant bank channel, and the banks examine them against the credit terms. If the presentation complies, the bank honors according to the agreed structure. That is the core idea. A letter of credit is not just a vague promise to pay. It is a bank undertaking to honor a complying presentation, and that means the documentary details control the outcome. This is the distinction exporters have to hold in their heads at all times. There is commercial performance and there is documentary performance. Commercially, you may have manufactured the goods correctly, shipped them on time, and fulfilled the contract exactly as your customer expected. Documentary performance is separate. The invoice, bill of lading, insurance certificate if required, packing list, certificate of origin, inspection paperwork, and any other named document all have to line up with the credit's requirements. Banks examine documents, not cargo, so even a very real and successful shipment can run into payment friction if the paper trail is inconsistent, late, or impossible to produce in the exact form the credit demands. A lot of exporters get caught because the biggest problems often start before the goods even move. The credit may call for wording that the freight forwarder cannot realistically place on a transport document. The shipment window may be too tight for the manufacturing and logistics timeline. The product description may be overly detailed in one place and shortened in another. The named documents may not match what the exporter or insurer actually issues in the ordinary course. On paper, the credit looks secure. Operationally, it may be fragile from day one. That is why the review stage matters so much. The right time to pressure test the credit is before shipment, while changes are still possible, not after the documents are already under deadline. The most common failure point in these transactions is not always pure buyer non-payment. It is discrepancy risk. A misspelled company name, inconsistent goods description, missing signature, late presentation, or non-matching transport document can all create a discrepancy. Some of those issues may be waived by the applicant. Others may delay payment or weaken the exporter's position after shipment. Once the goods are gone, even a small documentary problem can become leverage for renegotiation or simply a source of cash flow pain. That is why disciplined document management matters so much. In a letter of credit transaction, the exporter is not only managing shipment execution, they are managing documentary precision under time pressure. There is also a broader structuring layer that should not be ignored. Who is issuing the credit, and how strong is that bank? Does the exporter need confirmation because of issuing bank risk, country risk, or both? Does the transaction also involve trade credit insurance, MEGA support, political risk coverage, or XM Bank working capital considerations elsewhere in the deal? The answer is not that one tool is always better or easier than another. The point is to line up the instrument with the actual risk being solved. Impello's role is advisory here. We help clients evaluate whether the credit language is workable, where documentary failure points sit, and how the letter of credit fits into the wider transaction, without pretending to replace counsel, trade operations teams, or the banks themselves. The key takeaway is that a letter of credit does not remove risk. It changes the form of risk. The payment question becomes a document compliance question, and that can be a meaningful improvement only if the exporter prepares for it with discipline before shipment. If you are dealing with credit wording, confirmation questions, or documentary risk in an upcoming export transaction, it is worth slowing down long enough to pressure test the structure while changes are still possible. In the next episode, we will cover documentary collections, where banks move documents but do not take on the same payment obligation as a letter of credit. Subscribe so you do not miss it, and leave any trade finance questions you want us to break down next.